Imagine walking into an American General store in the year 1825. The wooden floor creaks beneath your boots. Barrels of flour, salt, and molasses line the walls. Iron tools hang from hooks behind the counter. A farmer enters carrying a basket of eggs, while another customer places a worn silver coin beside a sack of coffee. But when the storekeeper opens his cash drawer, there is no neat stack of identical dollar bills. Instead, the drawer contains a confusing collection of objects: American copper cents, Spanish silver coins, notes printed by distant banks, handwritten promises of payment, and perhaps small pieces of paper issued by local businesses. Some customers have no money at all. Their purchases are recorded in a thick ledger to be paid after the harvest. This was the financial reality of the early United States. Long before Americans carried federal paper dollars in their pockets, they lived in a country where the meaning of money could change from one town to the next. The United States had declared its independence, written a constitution, and created a national government. Yet it had not created a single, dependable paper currency that everyone was legally required to accept. Paper money did exist before 1862. Colonial governments had printed it. The Continental Congress had issued it during the Revolutionary War. State-chartered banks also produced thousands of their own notes. But these were not the uniform federal dollars Americans recognize today. Before the Civil War, money was a mixture of metal, paper, credit, and personal trust. For many Americans, the safest form of payment was known as specie, gold or silver coin. A silver coin had value because the metal itself was valuable. It did not depend entirely on the promise of a government official or a distant banker. A merchant could weigh it, inspect it, and sometimes test its authenticity. Among the most familiar coins was the Spanish silver dollar. For generations, Spanish and other foreign coins circulated throughout North America alongside coins produced by the United States Mint. The Spanish dollar was widely recognized, especially in trade, and its influence can still be seen in the American habit of dividing a dollar into smaller parts. The expression 2 bits, meaning 25 cents, came from the practice of cutting or counting the Spanish dollar in eighths. In theory, the federal government was building an American coinage system. In practice, there were rarely enough American coins to satisfy the needs of a growing nation. Foreign coins continued circulating, especially in areas where official U.S. currency was difficult to obtain. Before national coinage became widespread, Americans routinely used a mixture of domestic and foreign money. The shortage was especially severe in rural communities. A farmer living miles from the nearest bank might see very little physical money during an ordinary month. His wealth existed in land, livestock, tools, grain, and the promise of future crops. When he needed flour, cloth, nails, or medicine, he often relied on direct exchange. A blacksmith might repair a wagon in return for corn. A doctor might accept firewood, eggs, or a young pig as payment. A storekeeper might provide supplies in the spring and wait until autumn to be paid. This was not always simple barter. Much of the rural economy operated through credit. The storekeeper kept a ledger containing the names of local families. Beside each name, he recorded what they purchased and what they provided in return. A family might owe $3 for sugar, lamp oil, and fabric. Later, the account could be reduced by delivering butter, timber, or wheat. The balance might remain unpaid for months. In a small community, reputation functioned almost like currency. The storekeeper needed to know who worked hard, who owned land, whose harvest had failed, and who had a history of avoiding debts. A promise from a respected farmer could be worth more than a suspicious banknote from hundreds of miles away. This system depended on relationships. It also created vulnerability. One bad harvest could trap a family in debt. An illness could prevent a farmer from working. A merchant facing his own financial problems might suddenly demand payment. Because formal money was scarce, economic survival often rested on the patience of neighbors and the strength of personal trust. In cities, the situation was different, but not necessarily easier. New York, Philadelphia, Boston, Baltimore, and New Orleans were becoming centers of trade. Ships arrived carrying goods from Europe, the Caribbean, and Latin America. Warehouses were filled with cotton, tobacco, sugar, tea, manufactured tools, and imported cloth. City merchants needed faster ways to move large amounts of value. Heavy bags of silver were inconvenient and dangerous. Gold was scarce, and coins could be lost, clipped, or stolen. Paper offered a solution. A banknote was easier to carry than a chest of coins. It represented a promise from a bank. Present this note, and the bank would redeem it for a specified amount of gold or silver. At least, that was the promise. Banks chartered by individual states printed their own money. Each bank designed its own notes, selected its own images, and placed its own name across the paper. One note might show an eagle. Another might display a steamship, a farmer, a locomotive, a classical goddess, or a portrait of a statesman. The result was a nation flooded with different pieces of paper. A traveler could leave Pennsylvania with notes from a local bank and discover that a merchant in Ohio did not recognize them. The merchant might accept the notes at a discount. A $5 bill could be treated as worth only $4.50, or even less. The farther a note traveled from the bank that issued it, the more suspicious people became. Could the issuing bank really redeem it in silver? Was the bank still operating? Was the note genuine? Had anyone in town ever seen one before? These questions transformed every transaction into a small investigation. A shopkeeper did not simply count paper money. He studied it. He examined the signatures, printing, borders, and illustrations. He considered the reputation of the issuing bank and the distance separating his store from the bank's office. The ordinary American was expected to understand a financial system filled with hundreds, and eventually thousands, of different notes. The federal government did not yet provide one uniform paper currency backed by national authority. The monetary system remained fragmented among coins, foreign money, private obligations, and state-chartered banks. The Library of Congress describes the pre-Civil War currency world as one in which metal money circulated while banks issued notes backed by supplies of gold and silver. For a time, the arrangement appeared to support the country's expansion. Banks helped finance farms, canals, stores, factories, roads, and Western settlement. Their notes allowed business to move faster than it could with coins alone. Paper promises began traveling across the nation, passing from worker to merchant, from merchant to supplier, and from supplier to bank. But every banknote carried a hidden condition. Its value depended on trust. And trust could disappear overnight. Behind the colorful images and elegant signatures was a system vulnerable to fraud, counterfeiting, speculation, bank failures, and financial panic. Americans had found a way to create more money, but they had not yet found a way to guarantee that all of it was real. In the decades before 1862, the greatest danger was no longer simply having too little money. It was accepting the wrong money. And as private banknotes multiplied across the country, distinguishing a valuable promise from a worthless piece of paper would become one of the most difficult parts of everyday American life. By the 1830s, the United States was expanding at a speed few earlier generations could have imagined. Canals connected inland farms to eastern ports. Steamboats carried cotton, timber, grain, and manufactured goods along the nation's rivers. New towns appeared beside roads, mines, and trading posts. Thousands of families moved westward, hoping to purchase land and build more prosperous lives. But this expansion required money. Farmers needed loans for land and equipment. Merchants needed credit to fill their stores. Manufacturers needed capital for machines and buildings. Speculators borrowed heavily, believing that property values would continue rising. Because the federal government did not issue a uniform national paper currency, much of this demand was met by banks chartered under the laws of individual states. These banks printed their own notes. To a modern American, the system would have looked almost impossible to manage. Instead of carrying standardized bills issued by one national authority, a person might possess notes from several unrelated institutions. Each bank selected its own designs, denominations, signatures, and promises. The notes could be beautiful. Some showed locomotives racing through the countryside. Others displayed sailing ships, eagles, factories, farmers, Native Americans, mythological figures, or portraits of national leaders. The elaborate artwork was intended to create confidence, but attractive printing did not guarantee that the money was safe. Every note represented a promise. The issuing bank claimed that the paper could be exchanged for gold or silver coin. A $5 note was supposed to be worth $5 in specie. But that promise mattered only if the bank had enough metal in its vault, and only if the person holding the note could reach the bank and demand payment. A banknote issued in New York might circulate easily in nearby cities. But once it traveled hundreds of miles into Ohio, Kentucky, or Missouri, its value could become uncertain. A merchant receiving an unfamiliar bill had to make a rapid decision. Was the bank real? Was it still open? Did it have enough gold or silver to redeem its notes? Was the bill genuine, or had a counterfeiter created it? Even an authentic note could be dangerous. If the issuing bank failed before the holder redeemed it, the paper might become nearly worthless. For this reason, banknotes often traded at discounts. A merchant might accept a $10 note for only $9.50. A note from a distant or suspicious institution could be worth much less. The discount reflected the risk, distance, and expense of returning the bill to the issuing bank. Money no longer had one clear value. The number printed on the note was only the beginning of the negotiation. To survive in this system, merchants and bankers used publications known as banknote reporters or counterfeit detectors. These guides listed banks, described their notes, warned readers about known counterfeits, and reported whether certain institutions were considered reliable. A storekeeper might keep one of these publications behind the counter. When a customer presented an unfamiliar bill, the merchant could search for the bank's name, examine descriptions of legitimate notes, and check the latest discount rate. But the guides were never perfect. Information traveled slowly. A bank could fail after the newest edition had already been printed. Counterfeiters could alter genuine notes, copy designs, or invent banks with convincing names. By the time warnings reached distant communities, false bills might already have passed through dozens of hands. Counterfeiting became a major part of American economic life. The variety of banknotes made the crime easier. Few people could memorize the designs of every legitimate bill. A person living in Pennsylvania might never have seen a real note from a bank in Georgia. If a counterfeit looked respectable and carried an official-sounding name, it might be accepted without question. Some criminals created completely false notes. Others altered the denomination of genuine bills, changing a $1 note into a 10. Certain counterfeiters copied the appearance of successful banks, while others produced paper from institutions that had closed or never existed. The victims were often ordinary workers and small merchants. A laborer could receive his weekly wages in banknotes, only to discover that one of them was counterfeit when he tried to purchase food. A farmer might sell livestock and accept notes from a distant bank, then learn weeks later that the institution had failed. The person who unknowingly accepted bad money usually suffered the loss. There was no simple customer service office to correct the mistake. There was no federal insurance protecting the value of the note. The bill became a worthless reminder that trust had been misplaced. Among the most notorious institutions of the era were the so-called wildcat banks. The name came to describe banks believed to operate in remote locations, places where, according to popular stories, only wildcats could easily reach them. Whether every story was true mattered less than the fear the term created. A dishonest or weakly managed bank could establish an office far from major commercial centers, issue large quantities of notes, and make redemption difficult. The farther the bank stood from the people using its money, the less likely note holders were to appear and demand gold or silver. As long as confidence remained strong, the system could continue. But when many people demanded redemption at the same time, the weakness became visible. Banks did not keep enough gold and silver to redeem every note they had issued. They depended on the assumption that only a limited number of customers would request specie on any given day. The rest would continue using the paper as money. This worked during periods of optimism. During a panic, it could collapse. News that one bank was struggling could cause crowds to gather outside its doors. Depositors demanded coins. Merchants refused its notes. Fear spread to neighboring institutions, even those that had been more careful. One bank failure could become a regional crisis. The Panic of 1819 demonstrated how quickly credit, land speculation, and falling prices could destroy livelihoods. Businesses failed, unemployment rose, farms were lost, and debtors filled local jails. The Panic of 1837 brought another devastating collapse. Banks suspended payments in gold and silver. Property values fell. Merchants closed their stores. Workers lost jobs, and families that had believed themselves secure suddenly faced poverty. For many Americans, these crises were not abstract economic events. They were personal disasters. A carpenter could lose months of savings because the banknotes in his possession were no longer accepted. A widow might discover that the bank holding her money had closed. A farmer who borrowed during prosperous years could lose his land when crop prices declined and creditors demanded payment. The debate over banking became one of the most emotional political conflicts in the country. Some Americans believed banks were essential to growth. Without credit, they argued, ordinary people could not purchase farms, open businesses, or build transportation networks. Others saw banks as instruments of privilege and corruption. They believed paper money allowed wealthy insiders to create value from promises while workers and farmers carried the risk. President Andrew Jackson became one of the most famous opponents of concentrated banking power. His battle against the Second Bank of the United States reflected a deeper national suspicion. Who should control money? Should that power belong to the federal government? To state governments? To private bankers? Or should Americans rely primarily on gold and silver? Jackson's victory over the national bank did not eliminate banking. Instead, state-chartered institutions multiplied. The result was even more paper currency circulating under different rules and different levels of supervision. Some states imposed strict requirements. Others allowed banks to operate with weak reserves and limited oversight. In the 1840s and 1850s, reforms known as free banking laws made it easier to organize banks in several states. Supporters believed competition would expand access to credit. Yet the quality of the notes still varied, and the public remained responsible for judging which promises deserved trust. Meanwhile, the nation's economy grew larger and more interconnected. Railroads carried people and goods across regions. Telegraph lines allowed information to move faster. Factories employed growing numbers of wage laborers. Cotton connected southern plantations to northern merchants and foreign markets. America was becoming a national economy, but it still lacked a truly national paper currency. The contradiction grew more dangerous with each passing year. Then came the Panic of 1857. A major financial collapse spread through banks, railroads, factories, and trading companies. Businesses failed, unemployment increased, and once again the public watched paper wealth disappear. Yet even this crisis did not immediately produce a uniform federal currency. The political system remained divided over the power of the national government, the role of banks, and the use of paper money. Many Americans still feared that government-issued notes would become worthless, just as the continental currency had during the Revolution. Then in 1861, the Civil War began. The conflict created financial demands greater than anything the United States had previously faced. The government needed to arm, feed, clothe, transport, and pay hundreds of thousands of soldiers. It needed to purchase horses, rifles, ammunition, ships, food, medical supplies, and railroad services. Taxes and loans were not enough. Gold reserves were under pressure. Banks suspended specie payments. The Union government confronted a terrifying possibility. It could possess soldiers, factories, and political authority, yet still lack the money necessary to continue the war. For decades, Americans had tolerated a currency built from coins, private promises, distant banks, and uncertain trust. Now the survival of the nation itself depended on finding another solution. In 1862, Congress would take a step that earlier generations had feared. The federal government would begin issuing paper money that did not simply represent the promise of a private bank. It represented the authority and the risk of the United States itself. By the winter of 1861, the United States government was confronting a crisis greater than any banking panic. The Civil War had divided the country, disrupted trade, frightened investors, and created expenses that increased every week. The Union needed to recruit armies, build warships, purchase weapons, transport supplies, feed soldiers, and support military operations across thousands of miles. War consumed money at a speed the federal government had never experienced. Before the conflict, Washington had relied heavily on customs duties and other limited sources of revenue. But those sources could not finance a war of this scale. The government borrowed from banks and private investors, yet borrowing alone was not enough. Confidence weakened as military costs climbed. In December 1861, major banks in New York, Boston, and Philadelphia suspended specie payments. In practical terms, they stopped exchanging their paper notes for gold and silver on demand. This was a warning. The Union still possessed factories, railroads, farms, ships, and millions of citizens. But the government lacked an adequate supply of reliable money with which to mobilize those resources. Congress faced a choice that earlier American leaders had repeatedly avoided. The government could impose dramatically higher taxes, borrow even more at increasingly unfavorable rates, or begin issuing federal paper currency that was not immediately redeemable in gold or silver. The last option was considered dangerous. Many Americans remembered the continental currency issued during the Revolutionary War. Its value had fallen so severely that the phrase, "not worth a continental," became a symbol of financial failure. Critics feared that new government paper would follow the same path. To them, real money was gold or silver. Paper was only a promise. Supporters of federal currency argued that the Union no longer had the luxury of waiting. Soldiers could not be paid with political speeches. Railroads would not transport supplies without compensation. Farmers, manufacturers, and merchants needed something they could accept in exchange for the goods required by the army. In February 1862, Congress passed the first Legal Tender Act. The law authorized the federal government to issue a new form of paper currency known officially as United States notes. Because of the green ink printed on the reverse side, Americans soon called them greenbacks. These bills were different from the banknotes that had filled the country before the war. A private banknote represented the promise of a particular financial institution. Its value depended on the issuing bank's reserves, reputation, and survival. A greenback, by contrast, represented an obligation of the United States government. The federal government declared that the notes could be used to pay most public and private debts. This legal tender status was revolutionary. A merchant might distrust the paper, but the law gave it a recognized place within the national economy. The new currency did not solve every problem. Greenbacks were not initially redeemable in gold, and their value fluctuated according to military events, public confidence, and expectations about the future. When Union prospects appeared strong, confidence in the notes improved. When military defeats or political crises threatened the government, their value could fall in relation to gold. The battlefield and the financial market became connected. News from places such as Antietam, Gettysburg, Vicksburg, and Atlanta influenced not only public morale but also the perceived strength of the currency. A greenback was more than a piece of paper. It was, in effect, a wager on the survival of the Union. For soldiers, the new money became part of daily life. A young man serving far from home might receive his wages in federal notes and send part of the money to his family. His wife could use those bills to purchase food, clothing, lamp oil, or tools. A farmer selling grain to the army might receive the same kind of currency as a factory worker producing uniforms in Massachusetts. For the first time, people across distant states increasingly encountered paper money issued under the same national authority. But the transformation remained incomplete. Private banknotes still circulated. Gold and silver coins continued to exist, although many disappeared from ordinary transactions because people hoarded them. Small change became so scarce that Americans improvised again. Postage stamps were sometimes used in place of coins. Merchants issued private tokens. Communities relied on tiny paper notes called fractional currency. Even after the introduction of greenbacks, the country's monetary system remained a mixture of old and new. The federal government also needed a more orderly banking structure. In 1863 and 1864, Congress passed national banking acts. These laws created a system of nationally chartered banks. The banks could issue standardized national banknotes backed by federal government bonds. Unlike the chaotic notes of the earlier era, these bills followed more consistent designs and were connected to a national regulatory system. The government then placed a heavy tax on the notes issued by state banks. The tax did not destroy state banking itself, but it made the continued circulation of state banknotes economically impractical. Gradually, the thousands of competing private currencies disappeared from everyday commerce. The change was enormous. Before the war, a traveler crossing the country had to examine every unfamiliar note. He needed to ask where it came from, whether the issuing bank still existed, and how much the bill was worth in the town where he was standing. After the federal reforms, Americans moved closer to a system in which a dollar carried the same recognized value from one state to another. That did not mean the debates ended. Some Americans believed greenbacks were necessary emergency money that should disappear after the war. Others wanted the government to continue issuing them. Farmers and debtors often favored a larger supply of paper currency, arguing that scarce money benefited creditors and wealthy financial interests. Bankers and advocates of hard money warned that excessive paper issuance could produce inflation and weaken confidence. These arguments continued long after the final Confederate armies surrendered. The legal status of greenbacks reached the Supreme Court. Political movements formed around monetary policy. Americans debated whether the nation should rely on gold, paper, bank credit, or some combination of all three. The government eventually moved toward making its notes redeemable in gold, and specie payments resumed in 1879. Yet greenbacks did not vanish. United States notes remained part of American currency for generations. The long-term importance of 1862 was not simply that the government printed paper. Americans had already used paper money for decades. The real change was that the federal government assumed a direct role in creating a widely accepted national currency. The dollar was becoming more than a coin, more than a private bank's promise, and more than an entry in a merchant's ledger. It was becoming an instrument of national power. The transformation also changed how Americans understood the federal government. Before the Civil War, many citizens encountered Washington mainly through the post office, federal land policies, customs laws, or military service. Now, federal money passed from hand to hand every day. A government that once seemed distant entered stores, factories, farms, railroad stations, and family homes through the currency in people's pockets. The greenback carried symbols of authority, but its true strength came from collective acceptance. People used it because others were willing, or legally required, to accept it. Its value rested on taxation, law, economic production, military power, and public confidence. In that sense, the new dollar revealed something fundamental about all money. A silver coin appeared solid because its metal had value. A banknote depended on the institution that promised to redeem it. A greenback depended on faith in the government and the nation standing behind it. By the end of the Civil War, the United States had not created the perfectly stable monetary system it would use forever. Banking panics, political battles, inflation, deflation, and financial crises would continue. But the old world of countless local notes was fading. The farmer who once paid a merchant with wheat, the worker who worried that his wages might be counterfeit, and the traveler who watched his money lose value each time he crossed a state line belonged to an earlier financial America. The country had entered the war with a fragmented currency system built on coins, private notes, personal credit, and local trust. It emerged with the foundation of a national dollar. Paper money did not truly begin in America in 1862. What began was something more important: the transformation of paper currency from thousands of uncertain private promises into a national promise backed by the authority of the United States.